So hi everyone, good morning. My name is James. I'm here from the Smith School of Business at Queen's University in Ontario, Canada. I'm here to you today for the Informs Operations Research and Analytics Student Team Competition. So let's get started. As I said, my name is James. I was the project manager for our group. So I was in charge of administration, documentation, and making sure that things are kept on track. I'm going to give you an overview of our approach to solving this challenge. Next, I'm going to hand it off to Ross, who is our lead developer, who will give you a technical overview of how we solve this problem. Finally, I'm going to hand it off to Silka, our financial analyst, who's going to give you an overview of our financial results and evaluation. So, why are we here today? We believe that we have come up with the best solution possible to this challenge. This challenge was based on the Markowitz portfolio optimization theory. The idea behind it is to minimize the trade-off between risk and expected return. In short, it's to increase risk-adjusted returns. We do this with this formula here. In addition to that, there were 3 constraints which were added on to the challenge. These constraints made it very difficult to solve this problem using purely traditional methods and forced us to think creatively and come up with different solutions in order to solve this problem. So, let me walk you through how we came up with our solution. Our approach was to use an iterative process of trying out different methods, different techniques, until we were able to come up with the best solution possible. We tried out a few different techniques during our research and design phase, which included simulated annealing, genetic algorithms, predictive modeling, and a few different other techniques using a variety of software. Once we tested out a few techniques, we determined that the optimization model was the most natural fit for this challenge. After this, we shifted into a development phase. During this time, we tried out a few different methods, measured them against a few key metrics which are listed here, in order to come up with the best framework possible. It was during this time that we concluded that using a brute force method and pure computational power was not enough to solve this challenge. We needed to think creatively and somehow simplify this mathematically and look at the constraints and the objective function in order to come up with a feasible solution. So that's what we did. In the end, our final model was coded in AMPL, and what we did is we simplified the objective function and leveraged the constraints in order to come up with a model that was very efficient, simple, and scalable. Let me explain to you exactly what we tried to do with our model. So you can see here is the efficient frontier based on traditional portfolio theory. What we tried to do is leverage the risk constraint that was listed as one of the additional constraints. What this risk constraint essentially did was it confined our risk boundary to this narrow column here. In addition to that, what we did is we could remove the inefficient frontier right here. This is where we started to focus our attention. Within these confines, what we did is we maximized our returns. This is where we pushed our model to land, and this was the approach that we took to solving this challenge. In the end, we believe that this gave us 3 key advantages to our model. Firstly, it's efficient. Our model rebalances in under 1 second. Secondly, it's simple. We're using a traditional optimization framework to solve this problem. Finally, it's scalable. We think that we could build this up to a much larger universe of stocks against any benchmark index. In the end, our returns were over 10% for annual turnover adjusted returns. We've since made some minor alterations to some of the parameters, and we've got this as high as 14% by adjusting some of the turnover constraints. However, we believe that this performance is very strong, and we believe that our computational power is excellent. So that's why we believe we have the best solution. Let me hand it off to Ross, who's going to give you a technical overview of the model.
Great. Thanks, James. Excuse me. Now, before we jump into the technicals, I wanted to ground everybody in some of the key assumptions that we've made in developing our solution. So first off, we're operating under the assumption that if we want to maximize returns, if we want additional returns, we are likely going to have to take on additional risk. And in that way, those two are going to be somewhat positively correlated, and we'll see how that plays in a moment. We also made a simplification to your cardinality constraint. And rather than look at only counting assets that have weights of greater than 0.001, we actually limit our model to select weights of 0.001 or above. And that helps not only with our cardinality, but you'll see how that actually plays into our active share constraint as well and how we simplify that. And with active share, What we needed to do was find some way to approximate your minimum function, and we've done that using the cardinality, and I'll show you how we do that. But the assumption here is that we can approximate that minimum function using a linear function, which allows us to then use it as a simple constraint in an optimization model. So let's start with the tracking error. This is the tracking error formula provided, and the first step we took was to simply square both sides and come up with an equation that looks like this. The reason we did that is because we can quickly see how this maps directly into the objective function that was provided. Now, this objective function made up of the tracking error and the excess returns led us to that assumption around, well, if we want to maximize our returns, we want the most expected returns we can get, we're going to naturally assume that we have to take on increased risk. Well, what does that have to do with our tracking error constraint? Well, for us, what that meant was that we will now be pushing out towards the upper bound of our constraint all the time. We're going to continually see, because tracking error is the measure of our risk, we're going to continually see it push upwards. As such, we can get rid of the lower bound on our tracking error. This becomes our new tracking error constraint, and it actually feeds a little bit further as we look to reformulate our objective function. Because of that, we also approximate that tracking error constraint as a constant. And when we do that, we can substitute it into our objective function and come up with a new objective function that looks like this. Now, by minimizing a negative, that's going to be the same thing as maximizing a positive. And so our final objective function looks like this. And this is greatly simplified over the provided objective function. It allows us to run that through an optimization model at very quick speeds, as James alluded to. And it utilizes and bases itself on the alpha values that were provided as part of the problem statement. And Silke will talk to you a little bit more about why we feel really confident doing that. So let's turn our attention to cardinality. As I mentioned, we simplified this by limiting our lowest possible weights to 0.001 as opposed to only counting those above. And then we simply solved this problem using what's called the big M method of linear programming. We define a selected variable here. It's a binary, takes on the value of 0 or 1, 1 when we select an asset, 0 when we don't. And we define these two constraints here, which help ensure that that selected variable will always take on the value that it should. From there, we simply sum our selected variable and ensure it resides between 50 and 70. So how does that perform? Well, you'll see from this graph that through 130 rebalances, we meet this constraint every time. Okay. Active share was the final one we had to deal with. And we started by, again, just simplifying the equation a little bit. We moved the 1 minus outside, and we get a new equation that looks like this. And we can see in that equation we have a minimum between the bench weight and our portfolio weight. So we asked ourselves, well, what do we know about those weights? Well, we know two things. First, because our portfolio never shorts, that's part of the problem statement, we know that our weight, WI, will always be greater than 0. We also know that the S&P 500 doesn't short, and because of that, the bench weight will always be greater than or equal to 0. These two observations allow us to make the assumption or the conclusion that the minimum between these will always be greater than or equal to 0, and as such, our lower bound becomes redundant. That helps us remove a constraint, and it also helps us move forward with this intermittent, and we'll see in a second how we go forward. We still have a small problem, and that's that we have a minimum function here, and that's not easily solvable as a constraint within a standard optimization model. So we have to get rid of it. Our solution was to leverage the cardinality assumptions we made before, and here's how we do that. We have a cardinality constraint that keeps our assets selected between 50 and 70. We know the S&P 500 is going to have a cardinality approximately 500 at all times. What that means is that anytime we select an asset, we can be pretty sure that our weighting will be higher than the benchmark weighting. And we know that because obviously we're choosing fewer assets that sum to 1, they're choosing more that sum to 1, our weights must be greater. We ran a test across all 130 rebalances and found this holds 96% of the time, and as such, we feel confident moving forward with this as an assumption. What that means is we can actually approximate this minimum function as simply the bench weight. Anytime we've selected an asset, the minimum should be the bench weight. And then we said, well, that's good, but what about all the times we don't select an asset? Well, the good news is we know when we don't select an asset that the value is 0, and therefore the minimum will be 0. And we also have this handy selected variable that we defined as part of our cardinality that helps us understand when we didn't select a variable or an asset. By multiplying our bench weight times our selected variable, we get a very close approximation to this minimum function, and that ultimately allows us to simplify our active share constraint to a very linear, easily solvable constraint that looks like this. This is the final constraint you'd see in our model. So how does that hold up? Well, you can see from this graph that we are constantly between the required boundaries, and we never quite get to the lower bound or the upper bound. And the reason for that is because our approximation actually slightly overestimates that minimum, and therefore we'll never get down to the 0, we'll never get up to the full 1. So at this point, I want to hand it over to Silke, who's going to walk you through the outstanding results of this model.
Thank you, Ross. So for the evaluation of our model, we looked at 2 different results. We looked at the technical results and at the financial results. One of the great advantages of our model is the very short runtime. It only takes around 0.5 seconds for our model to run per rebalancing date. And it takes around 1 minute to run over all 130 periods. This means that our model is not just a great tool for asset allocation, it's also a great tool for backtesting and scenario testing. We calculated the required scoring metrics, and as you can see here, our portfolio-adjusted turnover-adjusted portfolio return was around 10.75% annually, which was around 5.8% below the benchmark return. We also calculated the cumulative return, and as you can see, our optimum portfolio return over the 10-year period was around 228%, while our turnover-adjusted portfolio return was around 178%, which means that we lost around 1.76% annually due to turnover. We also plotted the monthly portfolio returns against the monthly benchmark returns, and as you can see here, we followed the benchmark return very, very closely with a tracking error of only 4.9%. When it comes to peaks and drawdowns, we seem to not perform as well as the benchmark. However, there are periods where we do outperform the benchmark. We outperformed the benchmark exactly 47 times during the 10-year period, while the highest outperformance is up to 4% per month, while we only underperform the benchmark by up to 3.6% per month. We also took a closer look at return in terms of market capitalization. As you can see here, we didn't perform as well as the benchmark did in market cap 1. This is large cap companies. A reason for that is our cardinality constraint. Given that we are only allowed to invest into 70 stocks, while the S&P 500 invests the majority of their weighting into large cap companies, means that we can never select as much, and we're probably going to be underperforming in that area in market cap 1. So we wanted to see how much performance do we lose due to the additional constraints. So what we did is we ran our basic Markowitz optimization model with the first 8 constraints and plotted it against our portfolio, including the 3 additional constraints. And as you can see, the basic Markowitz model gives us a cumulative return of 356% annual return, while our portfolio had a cumulative return of 228%, which means that we lose roughly 5% due to the additional constraints. We also took a closer look at the alpha scores. Given that our model selects the assets with the highest alpha scores, we wanted to see how well the alpha scores are in predicting future monthly returns. So we plotted them against each other, and as you can see, our alpha scores follow the monthly returns very, very closely, so we're confident in using the alpha scores as an indicator for future monthly returns. I'm going to hand it over to James for a short summary. Thank you.
Thank you, Silke. So, I would like to conclude by saying that we strongly believe that we have the best solution possible. The reason for this is because our model is efficient. We're able to rebalance in about half a second. Secondly, our model is simple. We're leveraging a traditional optimization framework in order to solve for this. Finally, we believe that our solution is scalable and that you could build this up to a much larger universe of stocks with a different benchmark index. We were able to reach over 10% annual turnover adjusted returns. We believe that there's still room for improvement if we were to adjust some of the parameters. We've addressed all the constraints, and in addition to that, our model is able to accommodate for preferences of risk and turnover. So, I'd like to end by extending a special thank you to Informs for hosting this competition and allowing us to come here and present, to Principal Financial Group for providing this challenge, providing the data, and making this such a strong and enriching challenge. I'd also like to thank the Smith School of Business at Queen's University, and a special thank you to Terry. I don't know if Tracy is here as well, but this is an excellent competition, and we're very thankful to be here. So, we've been very eager to come here. We fought through ice and snow to get here. We really like to hear your feedback, so we're going to open for questions and commentary. So thank you very much.